Hello everyone, welcome back to my YouTube channel. In the last class, we learned about maintenance of capital accounts of partners, right? So there are mainly two methods. First one is fixed capital method and second one that is fluctuating capital method. So under fixed capital method, we need to maintain two accounts. They are capital accounts and current account. So under partners capital account, that shows only opening capital and additional capital and permanent withdrawal of capital. Clear? And in the current account, we record all the adjustments like drawings, interest on drawings, interest on capital, salary, commission, share of profit or loss. Right? So this is fixed capital method. And in fluctuating capital method, we maintain only one account, that is partners capital account. Here we will record all the adjustments like share of profit, additional capital any introduced, interest on capital, drawings, interest on drawings, salary or commission. This is the fluctuating capital method. So in today's class, we are going to solve one practical problem under fixed capital method and fluctuating capital method. Clear? So let's start it. Samir and Yasmin are partners with capitals of rupees 15 lakh and rupees 10 lakh. So this is the opening balance, means by balance brought down in fixed capital method under partners capital account. They started the business with opening capitals of rupees 15 lakh and 10 lakh. They agreed to share the profits in the ratio of 3:2, means the agreement is made between Samir and Yasmin. So if there is no agreement to share the profit, what we have to do? We need to follow the provisions of Partnership Act 1932. I have already explained this, right, in the last class. So if there is no agreement between the partners, we have to share the profits equally, means in the ratio of 1:1. Show how the following transactions will be recorded in the capital accounts of the partners in case the capitals are fixed and the capitals are fluctuating, means under fixed capital method and fluctuating capital method. The books are closed on March 31st every year. Additional capital introduced on October 19, 3 lakh, 2 lakh. Interest on capital 5% for both. Drawings 30,000 and 20,000, interest on drawings 1,800, 1,200, salary 20,000, 7,000, commission that is only to Samir, that is 10,000, and share in profit 60,000 and 40,000 already calculated, right? So now let's start the problem. First one is we need to solve under fixed capital method. So in that we will maintain two accounts, that is partners capital accounts and partners current account, right? So in that first one is partners capital account. So this is the format. First what we have to do, by balance brought down, only three entries. First one opening balance, additional capital introduced and permanent withdrawal, right? By balance brought down, here see, they started the business with opening balances of rupees 15 lakh and 10 lakh. So write down 15 lakh and 10 lakh. Now by bank, that is additional capital introduced on October 19th. How much? That is 3 lakh and 2 lakh. Write down 3 lakh and 2 lakh. Clear? Till here it is clear, right? Now if there is permanent withdrawal of capital, we need to write down to bank, but here there is no permanent withdrawal of capital. But you have the question now that here in the transactions or information they have given the drawings, right? So what about this drawing? So don't get confused. So this drawing goes to partners current account under fixed capital method. It will not come under partners capital account. Clear? Because this drawing, that is temporary withdrawal for personal use, means it does not reduce the capital. It does not reduce the capital recorded in current account, partners current account. So if in the problem they mention permanent withdrawal, they need to mention specifically that permanent withdrawal. means it results in permanent withdrawal of capital. Then it goes to partner's capital account under fixed capital method. So don't get confused here. So in our problem, this drawing, that is temporary withdrawal, means it does not reduce the capital and it goes to partner's current account. Clear? So here there is no permanent withdrawal of capital. So here now we need to close the account. So here credit side is more, totally 18 lakh and 12 lakh. Right? Now March 31st to balance carried on 18 lakh and 12 lakh. Here also totally 18 lakh and 12 lakh. Now this account is closed. Clear? Now in the fixed capital method, one more account we need to maintain, that is partner's current account. All the adjustments will come here. Clear? So under partner's current account, first we need to write down interest on capital. Interest on capital we need to calculate. They have given the percentage 5% to both Samir and Yasmin. Now let's calculate the interest on capital. First, we need to calculate the interest on capital for the opening balances, that is 15 lakh and 10 lakh for whole year. Whole year. Clear? And in between, means in October, they introduced the additional capital 3 lakh and 2 lakh. For this, we need to calculate the interest for not whole year, that is for only for 6 months. Be careful here. Clear? From October to March. October, November, December, January, February, March. 6 months, right? This is for 12 months opening balance, right? So let's calculate first for Samir. So calculation of interest on capital. 5% on rupees 15 lakh for 1 year. That is for opening balances. How much? 75,000. And on additional capital, he introduced 3 lakh rupees. Only for 6 months, 5%. That is 3 lakh into 5% into 6 divided by 12, 7,500 will come. Total 82,500 for Samir. Now what about Yasmin? First we need to calculate the opening capital. That is for 1 year or 12 months. On 5% on rupees 10 lakh, that is 50,000. And additional capital he has introduced rupees 2 lakh. For 6 months, 5%, how much? 5,000, 55,000 total interest. Clear? So I hope this is clear to you all. So write down here interest on capital for Samir 82,500 and for Yasmin that is rupees 55. Sorry. Yasmin that is 55,000. Clear? Now next we will go to salary. Partner's salary. How much? Partner's salary, yeah, 20,000 and 7,000. After that, commission will come. Commission, how much? 10,000 only to Samir. And by profit and loss appropriation, how much? By profit means credit side, 60,000 and 40,000. Clear? So go to the debit side and write down withdrawals. Temporary withdrawal means debit side, right? To drawings 30,000, 20,000 and interest on drawings how much? 1,800 and 1,200. Clear? All these are profits. Partner salary, commission, profit. So go to the write down on the credit side and all the withdrawals, that is on the debit side. That's it. Simple logic, right? So and here credit side is more, so write down on the debit side to balance carried on and total the credit side and write down the remaining balance from 1,72,500 deduct 30,000 and 1,800. How much balance carried on? 1,40,700. Here 80,800. So close the accounts. Clear? So this is under fixed capital method, but be careful in drawings and calculation of interest on capital. Clear? That's it. Now next one is fluctuating capital method. Here also same format. Here we are going to maintain only one account, that is partner's capital account. First, by balance brought down, opening balances, opening capital 15 lakh, 10 lakh. By bank means additional capital introduced, that is 3 lakh and 2 lakh. Interest on capital already we have calculated here, right? 82,500 and 55,000. Salary 20,000, 7,000. By commission 10,000 only to Samir, and by profit how much? 60,000 and 40,000 to Yasmin. Clear? Now here debit side all the withdrawals. To drawings 30,000, 20,000. To interest on drawings 1,800 and 1,200. Once we prepared the fixed capital method under partner's current account, it is easy to prepare the fluctuating capital method. But here only one account it is maintained. We need to record the additional capital introduced in the partner's capital account only. There are no two accounts we need to prepare. Clear? That's it. That is only the main difference. And credit side is more, and total the Samir amount, that is 19,72,500, and here to balance carried on, from that you need to deduct 30,000 and 1,800, then you will get 19,40,700. Here also total the Yasmin's amount and deduct 20,000 and 1,200, you will get 1,28,800. Clear? Close the account. Clear? So I hope this problem is clear to you all. In this way, we need to prepare the accounts under fixed and fluctuating capital method. Clear? So before solving this problem, please watch my previous class. In that I have clearly explained what is fixed capital method and fluctuating capital method. Then it's easy to solve this problem. Clear? So if you have any doubts in this class, please leave a comment. Thank you.